The market seems to be overly eager for interest rate cuts, and investors really need to be careful for what they wish for. Lower rates are typically looked at as bullish for stocks, but JPMorgan is warning that the upcoming Federal Reserve decision could actually spark a major market sell-off instead. If you paid attention, the stock market has already been sent higher in anticipation of easing rate policy, but likewise, traders may sell stocks hard after the news because the outcome has already been priced in. And what we find oftentimes in markets is that you buy the rumor and you sell the news. That makes now a very good time to brace your portfolio before the Fed acts. Stocks have climbed all year on expectations of easier monetary policy. Last month, Fed Chairman Jerome Powell remarked that a cut could be justified, and since then the S&P 500 has gained nearly 2%, adding to a more than 10% gain for the year. Now, traders expect 3 rate cuts in 2025, starting with a 25 basis point move this month and more to follow in 2026. But JPMorgan's trading desk has cautioned that these expectations may already be priced in. When markets anticipate policy shift, there's little room left for upside. Instead, the actual announcement can trigger a pullback as traders take profits. Notably, inflation is still running above target, and employment data is sending mixed signals, and so the upcoming cut may highlight weakness instead of fueling growth. JPMorgan has outlined several reasons why a rate cut might not provide the lift that investors are expecting. Each of these factors points to the risk that could leave markets vulnerable. First, we have the labor market and its concerns. The labor supply is tightening. Lower rates could increase demand for workers. That would push wages higher, keeping inflation sticky. Instead of calming inflation fears, a cut could actually reinforce them. We also have the Fed's reaction function. Now, this refers to how the central banks adjust policy in response to economic data. Investors will be watching to see how much inflation the Fed is willing to tolerate. If the market thinks the Fed is putting growth ahead of price stability, confidence could weaken. We also have investor positioning, where U.S. stocks remain heavily owned, but positions are starting to shift. Investors who are overweight in equities are scaling back, and at the same time, share repurchases by the S&P 500 companies, once a steady support for markets, have slowed after hitting records earlier this year. Now, with fewer buybacks, stocks may lack an important cushion against that volatility. We also have retail investor momentum. Now, this year, individual investors have often stepped in to buy the dip. Large institutions were forced to follow, but enthusiasm from retail trading is now waning. Without that extra layer of demand, the market may not find as much support if prices begin to fall. Now, David Kelly, Chief Global Strategist at JPMorgan Asset Management, warned that rate cuts are not a cure-all. Retirees and fixed income investors could see their incomes decline. Lower interest rates reduce the yields on savings accounts, bonds, and other income-generating assets, so spending power is then reduced and consumer-driven sectors are weakened. At the same time, many households may hesitate to borrow money, even at lower rates, if they remain worried about potential recession. So with these risks in mind, JPMorgan has advised investors not to overcommit to equities. Instead, hedging against downside risk is a prudent strategy. Both JPMorgan Chase and Goldman Sachs have highlighted gold as an asset to consider. They note its role as a hedge when the dollar weakens under rate cut expectations. In fact, gold has already climbed to new all-time highs of $36.50 an ounce as markets prepare for the Fed to begin easing. Some analysts and banks believe gold prices could rise as high as $4,000 an ounce or beyond even this year still if the Fed signals significant cuts ahead, as a weaker dollar would only add fuel to gold's momentum. Now, bond market dynamics also support the case for gold. The sheer scale of government debt could eventually push borrowing costs higher. If confidence in U.S. debt falters, the Fed may need to intervene by buying treasuries, which equates to printing money. That policy fuels fears of inflation and debt sustainability, both of which tend to drive investors into gold. Now, the Federal Reserve's September 17th meeting may deliver the rate cut investors have been waiting for, but it could also serve as a significant turning point in markets, highlighting fragility in an overheated market. So if you're concerned about potential volatility, interest rate cuts creating instability in the markets, and the overall state of the economy, I'm Mackay Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical precious metals into your portfolio can give you the hedge that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.